Assalamualaikum. Hi everyone. Now we are reaching the final part of this video on chapter 6, analyzing operating activities. Okay, now without further ado, let's continue with our first studies part. So for my kind reminders that you might need to use your headphone or earphone for better audio quality. Okay, now let's continue. So the next part, we are still under the special revenue recognition. Okay, on the third item, which is franchise revenue. Accounting standard for franchises require that franchise fee revenue from franchise sales be recognized only when all material, services or conditions relating to the sale are substantially performed or satisfied by the franchisor. This also applies to continuing franchise fee, to perform continuing product sales, agency sales, repossessed franchises, franchising costs, combined revenue, and relationship between a franchisor and a franchisee. Next one will be under revenue under contract. Accounting for long-term constructions, contracts for items like buildings, aircraft, ships or heavy machines possess conceptual problems for the determination of a revenue and profit. The standard requires companies to use the percentage of completion method when reasonable estimates exist for both costs to complete a contract and progress toward completion of the contract. A common basis of profit estimation is to record part of the estimated total profit based on the ratio of costs incurred to date divided by expected total costs. Other acceptable methods of estimation are based on units completed, engineering estimates, or units delivered. Under this method, current or anticipated losses are fully recognized in the period when they are initially identified. So basically, in your slide, you can see that I list down two types of revenue recognition under contracts. The first one I already explained to you in terms of percentage of completion method. The second method is completed contract method, where it will consider all income and expenses directly related to a long-term contract as received when work is completed. So this will be the slight definition or brief definition of revenue recognition before delivery, which is the percentage of completion. So the industry must use percentage of completion method when the estimates of progress toward completion, revenues and costs are reasonably dependable and all of the following conditions exist. Number 1, contract clearly specifies the enforceable rights regarding goods or services by the parties, the consideration to be exchanged, and the manner and the terms of settlement. Buyer can be expected to satisfy all obligations. And number 3, when the contractor can be expected to perform under the contract. So this will be the formula to recognize revenue in percentage of completion method. Next, in terms of completed contract method. Companies recognize revenue and gross profit only at point of sales. That is when the contract is completed. Under this method, companies accumulate costs of long-term contracts in process, but they make no interim charges or credits to income statement account for revenues, costs, or even gross profit. Companies should use the complete contract method when one of the following conditions applies. When number 1, when the company has primarily short-term contracts, or number 2, company cannot meet the conditions for using the percentage of completion method, or 3, there are inherent hazards in the contract beyond the normal recurring business. Number 5 under special revenue recognition is unearned revenue. Under long-term performance contract, such as product warranty contract and software maintenance contracts, revenues are often collected in advance. Under such circumstances, revenues are recognized proportionally over the entire period of the contract. The logic is that accounting is that although revenue in this case is realizable, it is not earned until the contract service period expires. The amount of revenues that are still unrecognized appear in the balance sheet as a liability called unearned revenue. Next one will be in terms of analysis application of revenue recognition. The income statement is important to the analysis and valuation of a company. This statement is also important to management for these same reasons and others, including its role in accounting-based contractual agreements, management pressure to achieve income-based result, management compensation linked to income and the value of stock option. Given management incentive, we rationally expect management to select and apply accounting principles that best meet their own interests but are still within acceptable accounting practice. So the objective of income reporting do not always align with management's incentives in this area. So our analysis must be alert to management propensities in this area and the accounting discretion available. So recording of revenue is a critical event in income determination. Our analysis must take aim at the accounting methods to ascertain whether they properly reflect economic reality. For example, if a manufacturer records profits on sale to a dealer, our analysis must inquire about dealer inventories and market conditions. Why? Because a real earnings activity consists of selling to the ultimate consumer. Now let's go to the next part in terms of the circumstances fueling questions about revenue recognitions. So the circumstances fueling questions about revenue recognitions include: number 1, in terms of lack of substantial equity capital in the purchasing entity other than that provided by the seller. Number 2, the existence of contingent liabilities such as debt guarantees or agreements requiring the seller to infuse cash into the purchasing entity under certain conditions. And number 3, sale of assets or operations that have historically not produced operating cash flows sufficient to fund future debt service and dividend expectation. So what can we summarize in terms of this analysis implication of a revenue recognition is that revenue should not be recognized until cash flow from operating activities are sufficient to fund the debt service and dividend requirements in terms on a full basis, or when the company's investment in the purchasing entity is or can be readily converted to cash and the company has no further obligation under any debt guarantees or other agreement requiring it to make additional investment in the purchasing entities. So that's all for our chapter 6, analyzing operating activities. So hopefully you can understand, and please read your textbook. So see you again in the next chapter. Assalamualaikum. Bye-bye.